Hello and welcome. My name is Barbara Armstrong and I'm from MSD UK. And today we're going to be talking about unicorns and zebras, an alternative investment option for the new world. And my job is very easy today. I introduce the speakers for this session, and if we have time at the end, I will also moderate questions. Just before I make the introduction, could I say, can you please, if you've got any questions, put those in the chat and I will come to you. So I'm just going to give people a few more seconds to get into the room before I introduce today's speakers. As I can see the numbers going up, I was just saying for those that are just coming into the room that if you do have any questions, would you please pop those into the chat or into the Q&A, should I say, and I will moderate the questions at the end. There may or may not be time for questions, really depending on how the session goes today. And my job now is to introduce to you our speaker for today on the subject of unicorns and zebras, an alternative investment option for the new world. And I'd like to introduce Chandresh Pala. Chandresh is an entrepreneur, as you might well have guessed, a mentor and digital transformation strategist who passionately believes in empowering people to create profitable, purpose-driven global businesses. Chandresh has over 20 years of experience and looks far too young, that has included working with leading consultancies and corporates through to launching multiple businesses in technology and creative sectors. Also helping founders of existing companies to grow and achieve successful exits. So this is the place to be if you want to know about unicorns and zebras, an alternative investment for the new world. Over to you, Chandra. Thank you very much, Chandra.
That's great. Thank you very much, Barbara, for that wonderful introduction. Thank you all for joining the seminar today. I hope you're having a good day. Good afternoon, good evening, or good morning, depending on where in the world you are. We're going to be talking about unicorns and zebras, and no, you're not joining the National Geographic Channel. We're going to be talking about it in the context of companies and investment options. I'm also joined by my co-founder Eliane as well, one of my co-founders. She will also be speaking later, potentially helping us with some of the questions. So some of you may not be familiar with the term unicorn. So what is a unicorn company? A unicorn company is typically a privately owned company which has a valuation of over $1 billion. And the way that it's reached that is very often through multiple rounds of very large VC funding. So it's gone through various stages and has had huge amounts of money pumped into it, really to try and scale the business. And very often these companies are companies which are unprofitable for many years. So they have to grow very rapidly. And the way that they grow is through having venture capital being put into them and really focused on rapid growth and really getting to market domination. So their whole strategy is really to capture the market. So having that sort of approach sometimes has its downsides. And with many companies, it isn't always in the best interest. So growth at all costs isn't necessarily a good thing. There are some great unicorn companies, but there are a lot of companies whose pure focus is around delivering value to shareholders and growing at all costs. Unfortunately, for some of those companies, they put that above doing good or what's good for the planet. And in fact, some of them actively do bad. And we think that there's a better way. In fact, the world has changed. People's perceptions have changed, people's ethics have changed, the way people think has changed, and we're becoming a lot more aware of our responsibility, not just to the world, but our future generations. And that's not just about doing good for the planet, but also the way that our future generations are thinking about wealth and investment is also changing. so that the way that they're putting money into investments is also being driven by being more socially conscious. And that's a big trend that is taking place right now. So future generations, and including, even past generations, are now becoming much more conscious and becoming a lot more environmentally conscious. They're becoming a lot more ethical. They want to really understand and believe in companies that they're buying products from and services from. And those companies really need to do better, because in the past they focused purely on making money, and now they need to take a more holistic view. So there's a big change in the way that people are really looking at companies and how they're selecting companies to work with. Some of you may be familiar with the UN Sustainable Development Goals. So these goals are a set of 17 goals that have been defined, and with a target of 2030 to really to bring about global change, positive global change. And the goals actually cover a number of things, everything from education to no poverty, also economic growth, infrastructure, justice, all kinds of things. And these goals are a set of targets that have been defined by the UN with very specific measurable outcomes. And there's a lot of energy being put on around the world by organizations and companies to try and meet these goals, because it's for our good and for the planet's good as well. So let's move on to zebras. Well, zebras are more real than unicorns, and they're also more profitable. And companies which are profitable can also be doing good for society. That's why they can be zebras. They can be black and white at the same time. Nowadays, it's not an option to just do one or the other. Now we have the ability to actually be able to do both. You can be a profitable company and be very conscious and also improve society as well. These companies very often don't just focus on growth. They focus on sustainable revenue. They focus on sustainable long-term business. So they're not just focusing on the revenue for this quarter or this month. They're actually looking at the business as a long-term investment, as a long-term venture. They want to stay in business for a long time and really grow sustainably. And they're not just focused on shareholders. They, of course, have a duty to their shareholders to do well, but also they want to treat their employees and customers really well. So they take a more holistic view, and they really want to grow their businesses in an ethical way. They want to involve the community. They want to promote collaboration, even within the industry. So unlike maybe some of the unicorns want to go for world domination. They want to wipe out everyone else. The zebras sometimes work together, and it's about community and collaboration. So they're a very different kind of company. And many of you probably know companies like this, because these companies are not necessarily the sort of billion-dollar companies, but they are very profitable. They can be generating large amounts of money. They could be 20 million, 30 million, 50 million, $100 million companies. So not small companies, but still very sustainable and profitable. So let's move on to some of the investment options. Some of these you're probably very familiar with, so I'm just going to touch on them. The first one is grants. Very often that's money provided by the government, and it's non-repayable. It's just a financial assistance that governments very often give to very specific sectors. Loans, so loans are typically from banks or other institutions, and effectively that's money that is borrowed and has to be repaid over time. And typically that's with interest at an agreed interest rate. Typically those repayments are fixed, so you need to pay monthly, and there's a set amount, and you have to pay the money, as part of the repayment, plus also the interest component, and that's fixed. So depending on, it doesn't matter how you're doing, you have to pay a fixed amount. Very often the loans have to have security. So you have to have some kind of asset backing. Very often when you're an entrepreneur, you have to give some form of security, and that might be your house, or if you're a company, you might need to give some asset as security. There are also a form of convertible debt. So this is debt that can convert into equity at a future priced financing round. A lot of companies, startup companies, are using this. There's something called a SAFE, a simple agreement for future equity, which a lot of companies are using. It is seen as debt, which is on the books, and then when they reach a priced round, so when it reaches a point where they can raise larger amounts of money, maybe through VC funding, then it converts into equity. And of course, the large proportion of investment in venture-backed companies is through equity investment. So this is money invested in a company and based on a valuation. And that valuation is always interesting because that needs to be agreed. And for startup companies, that can be quite tricky, really to understand what the valuation is. But effectively, it's giving away a part of your company to somebody else in return for funding. And then there's another option called revenue-based financing, and that's really what we're going to be focusing on right now. Before I go into that, as a founder, I mean, I've founded many companies and I'm working with founders. Let's just talk about what founders want. One thing they want to do is to build their business. They want to grow their business, they want to get new sales. But actually, one of the reasons why people start their own businesses is because they want to retain control. They don't want to be reporting to other people. Very often, you know, people have worked in very good corporate jobs and they leave those jobs because they want to be in control. You know, they want to be their own masters. They also want to beat the odds. Being an entrepreneur, a lot of it is about really going against the odds, you know, succeeding and doing anything that is required to increase the chances of success. So part of that is kind of hustle. You may have heard the term hustle, but anything that you can do to increase your chances of success is what entrepreneurs do. Now that may be connecting with great mentors, it might be connecting with great communities, it might be doing anything that you need to make your business a success. Nowadays, founders also want to make a positive difference. It's not about the money. Very often people start companies because they want to really make a difference. They passionately believe in their product and their service and the ability to make a change in the world. And the reason that they're doing it is because of that change. And earning a lot of money is a byproduct of that. It isn't the main driver for many people. For some, it may be, but for many people nowadays, that's not the key driver. So let's talk about angel investors. Angel investors are people who invest in startup companies and scale-up companies. Well, as an investor, obviously one of the key things that an investor wants is to see market-leading returns for that particular asset class. So they want to see good returns, which are really going to create value. They also are doing it because they want to use their knowledge to help the founder succeed. They have a lot of experience typically, and they've made a lot of mistakes like me. And they want to help the next generation. They want to pass on that knowledge. They want to get involved in exciting new companies. They want to really improve society by helping people to create successful companies, because they know that if that company succeeds, then there'll be a win-win for everyone. And what they also want to do is to generally improve society and the economy. So by putting money into startup companies, the companies will do good, they'll employ people, and generally the economy will succeed. They also really want the excitement as well. You know, they want to stay sharp, they want to be involved in leading edge companies. So there's a lot of exciting things going on, and they want to keep on the pulse of what's going on. And it's exciting. You know, if you're an investor in a high-tech company which is growing fast, it's an exciting thing. So it's a great way of keeping up to date with what's going on and really keeping sharp, mentally sharp as well. They also want to connect with like-minded people. Once people sometimes stop working, they maybe miss the connections. So the ability to connect with like-minded people and be part of a community is also a really strong motivator for angel investors. So equity investing, a lot of people do it. It's a huge industry and, you know, does a lot of good in many companies. But there are some issues with equity investing sometimes. One of the big challenges is very often the valuation. The valuation is for a company, and very often a company may not be even generating any revenue, is a problem. Because without sales, and if you're an early stage company, very often the founders will think that the company is valued a lot more because they've been seeing all the news about all these amazing companies and their crazy valuations. And the venture capitalist or the investor will look at it very differently because they see a lot more risk. Very often the investor and the VC will want that company to move a lot faster. And sometimes that's not in the best interest of the founders. They maybe want to push them to expand into new geographies. They want to maybe increase their sales, increase their headcount, and all kinds of things, and be able to, you know, push them to move fast. And very often that isn't in the best interest of the company. The other thing that founders obviously have an issue with is loss of control. So when you give away equity, it means that you're giving away a piece of the company. When you do that over multiple rounds, it means that you're giving away more and more of your company. And therefore, you reach a point when you actually have less and less control. So as a founder, you can find that you're in a position where you've given away a large proportion of your company, and actually you're not in control, and you can actually be thrown out of the company. One of the issues for an investor is when you put money into these companies and you are, you know, based on equity, then that money is actually effectively locked in until there's what's called a liquidity event. Liquidity event is either a sale or an IPO or some major event which allows you to release that equity or those funds. What that means is that typically investors in these companies won't be able to get access to the money for a very long time. That could be 5 years, 10 years, or, you know, or until, you know, some major event, which means that that money is effectively locked in and that you can't do anything with it. So here's an alternative, revenue-based finance. It fits certain scenarios. So there are tools for all kinds of scenarios, but I'm just going to talk to you about revenue-based finance, which is potentially a better and a new option for certain types of companies. It won't fit everyone. So what is revenue-based financing? Well, revenue-based financing means that a company provides investment into a company, an investor provides investment into a company, and investors receive a percentage of the gross revenues from that company. Now, that is based on that company providing a multiple of the principal investment. Typically, that's between 3 to 5 times the original investment. And that carries on until that amount has been repaid. So it's over a period, and it's basically paying a certain amount from your top line sales, an agreed percentage. So let me just explain some of the advantages of revenue-based financing compared to maybe some of the other ones. Firstly, because you are paying a percentage of your sales, it means that they're variable payments based on the level of revenue. So unlike a bank loan where you have a fixed amount, revenue-based financing means that you only pay when you are earning, and you only pay to the level that you're earning. So it means if sales are down 1 month, then you pay less. If they are very good another month, then you pay more. So it works really well. You can also pay off a large proportion quicker if your sales are doing better than you expected. So it's variable and it's aligned with the company's goals. One of the other advantages is, unlike maybe bank loans, it's not secured against assets. So which is a great relief if you're a company and if you're a founder, you're not having to put your house on the line. Compared to venture capital, there's also no dilution of equity or loss of control. So typically with revenue-based financing, there isn't a large equity that you're giving away. It's just an agreement to pay a proportion of your sales until you reach that target amount. So it means that you retain control. As an investor, what it means is that you can actually start seeing returns very quickly. As soon as the revenue share starts kicking in, and that can be very soon, it means that you're actually getting either monthly or quarterly returns of money coming back to you. Now, what that means is that you're actually seeing a return on your investment, and you can actually recoup that initial investment very quickly. And that means that's a low risk for you as an investor. So you actually have the ability to recycle that investment into other investments or to put more money into the same company, which is absolutely fantastic. So let me tell you a little bit about Epic and Epic Hub. And I'll also tell you about some of the kind of structures that we're talking about and the criteria that we look for when we're looking for companies to fund through revenue-based financing. Firstly, our mission really is to accelerate positive impact by democratizing investments. We want to accelerate the development and target to reach those sustainable development goals by helping everyone to be able to invest in companies that are doing good. We have a great team, and it's a very diverse and very talented team. We have Eliane, who's joining us from Holland today. We have Clarence, who's down in Australia, and Matthew is also down in Australia. So we are a really diverse team, and we're all absolutely passionate about making a positive difference. So this is just an overview of our criteria. So for revenue-based financing to work, one of the key things is that the company needs to be either at or near revenue. Obviously makes sense for revenue-based financing. So really it's not for companies which need a lot of investments or need lots of clinical trials and medtech and some of these very research intensive, finance intensive companies. So it's specifically for companies which are either at or near revenue. So maybe they've gone through that research process and are now at revenue. That's fine, that would work. So it needs to be a proven concept. Secondly, they need to be impact focused and aligned with one of the sustainable development goals. So we're looking for companies which are impact focused. We're also looking for companies which have a profit margin of greater than 30%. So for the revenue share to work, there needs to be enough profit margin in there. And they need to be highly scalable. So these are companies which can scale. Having received the investment, they can be scalable and grow. So we're looking for companies which have exponential potential. This is an example of a typical deal structure. It's not set in stone. It's all open to discussion, but it'll give you a flavor of the kind of deal structure that that is possible. So if we just talk through this, so typically we can put in an investment of say 500,000, and we're looking for a multiple of 5 times that within 5 years. Now that is repaid back as a percentage of the revenue. Typically that can be 10%, or it can be whatever we agree as the right amount for you. And those revenue share payments will start at the agreed date. So depending on what makes most sense for the company and for you. There is some equity. It's only a small 1%, which we retain, which is our exponential ripple of impact. But apart from that, no other equity is retained. So what that means in terms of benefits is that, as I said earlier, the payments are based on actual revenue. So If you make more money, then you pay off that amount quicker. If you don't make so much money, then it takes slightly longer to repay. As an investor, you're getting repayments paid monthly or quarterly. And our platform, the Epic Hub platform, basically deals with all of the administration, the distribution, the reporting of all the payments. What we also have within Epic is we're connected into some great communities, and we have a great network of mentors and specialists. And what we do is really to help those companies that we invest in to grow, because it's in everyone's interest for those companies to succeed. And part of our offering is to make sure that we connect you with the best people who can really help you to grow your business. So we have regular reviews and support sessions to really to assist founders. And as an investor or as a specialist, we want to connect with you because we can't be experts in everything. So we are connected with specialists in many different subjects, either pre-investment or post-investment. And we're always really interested to talk to people who are specialists and really want to be part of a community helping to grow businesses. So I'd like to talk about one example. So this is a case study and a live deal that we're actually raising for right now. This is a company called GoGoTech, and they make lightweight portable wheelchairs, electric wheelchairs. So one of the issues is that there are so many people who really need wheelchairs and have mobility issues. And yet the number of people that can either afford even just a non-powered wheelchair, and even less people that can afford powered wheelchairs is really terrible. If you just look at the numbers, there are so many people whose lives would be improved if they had access to better mobility. So the mission for GoGoTech is to be able to provide not just a highly functional, really up-to-date, modern, and technically advanced wheelchair, which is motorized with all the latest features, but to be able to do it at a price point which makes it super accessible to as many people as possible. So the idea is to democratize access and to improve people's lives. It's a really amazing engineering feat that they've managed to achieve here, because creating something which is advanced and does some great features is possible, but to do that at a cost point which is accessible, and to do it when it's lightweight and portable really does take a lot of engineering. And it has some amazing features. It's got robotics, it's got great range, it's lightweight, it's foldable, it's got great connectivity. So this is an amazing company. We are raising an investment round for them. If you're interested in investing in this company or knowing more about the product, just let me know and we can connect you. But it gives you a flavor of the kinds of companies that we're investing in. So I'm going to go to Barbara and just see if there's any questions. If you want to connect, then we're interested in connecting with startups and scale-ups. If you're interested in getting investment, then obviously come and talk to us. If you're an impact investor, we're growing a community of impact investors. We also want to connect with accelerators, incubators, and any specialists. And if you're an impact fund, then come and talk to us as well. Any questions, Barbara? I don't know if...
Thank you very much for that, Chandresh. There aren't any questions in the box. Actually, hold on 1 second. One has just come up from Jeru. What types of companies have you funded this way before? Sectors that work well with this sort of funding, e.g. retail, as a question mark.
Okay, so Epic is relatively new, but actually, the concept of revenue-based financing has been around for a very long time. Traditionally, it's actually been things like games or film and creative sector, because they typically needed a large amount of money to be put into a project, And then once they had created a product, then the margins were actually very, very good. So they could then create revenues. We currently have 2 live deals, and we have a portfolio or a pipeline of about 15 other deals that we're looking at right now. There's no one single type. As long as they meet those 3 primary criteria, then we'll look across sector and look across any geography as well. So just to reinforce that, they need to be either at revenue or close to revenue. They need to have a good profit margin, greater than 30%, and they need to be impact focused, and they need to be scalable. So as long as you meet that criteria, then we're happy to talk to you.
Wonderful. I have one more question, which we just about have a little bit of time for. And this says, for startups, revenue is often much easier to acquire than operating profit-margin. This comes over time. RBF taking revenue away from the company so soon, which they could alternatively reinvest into the business, makes it more likely that the company will fail in the short term. So isn't this type of financing self-defeating? In this sense, it seems to me a worse option than giving away equity to VCs, given there is such a huge risk of companies failing in the first 2 years.
Yeah, and it's an interesting feedback. Of course, I think it depends on the company. So like I said, it fits certain companies, it doesn't fit other companies. The other way of looking at it is equity can be worth a huge amount. So as a founder, and I know because I founded a number of companies, equity is the most valuable asset you have. If you truly believe in your company and you truly believe that you are going to grow, into a very big company, then equity is actually incredibly valuable. I would rather give away some of that money initially to be able to retain the equity. If you think about a lot of the companies that have grown to huge, sizes, their equity is worth a huge amount now. So that's the other reason for that criteria. You need to have a profit margin of 30% or more. And you're right, if it's less than that, then yes, that is going to damage the company. But if you have that, and you know that by putting in a certain amount, you have the ability to scale, and that's just going to boost your sales, then yes, it does fit. So, there are certain types of companies it works for, there are certain types of companies it won't work for. Equity will be a better option.
Thank you for that, Chandresh. I do have one more, and after this, I'm going to leave it there because we're over time. And this question is from Natalie. What about civic tech? i.e., we're a startup developing voice AI to enable housing and homeless teams to understand and communicate with diverse ethnic voices to combat bias and barriers for people with protected characteristics. And she adds, i.e., would voice AI, SaaS, software as a service, be a sector stroke industry that is suitable for RBF?
Yeah, like I said, we are open in terms of sectors. We're looking at all kinds of things. I mean, we're looking at everything from, the wheelchair to vertical farming to education. So it's not so much the application, as long as it meets those criteria and it's revenue generating, then we're happy to look at it. It's really about the criteria. It needs to be a company which has that margin, has the scalability, because that's where that's how it works. So as long as your company meets that criteria, then it can work, yes.
Thank you very much for that. I'm sorry that we did go a little bit over, but I thought it was worth answering those few questions.
Of course,
Chandresh.
my pleasure.
So thank you very much. A very insightful, very easy and straightforward to understand presentation. So I'm sure that everybody that attended got a lot of benefit from that. So can I just say thank you to you and to Ellie. Sorry we didn't get a chance to talk to you this time, Ellie, but nice to have you on the call as backup there, and we'll see you again next time. And to everybody else that attended, thank you all very much, and good evening or good morning. Thank you very much.
And if you have any questions, obviously you can see my contact details on the screen, so feel free to reach out and connect with us.
Absolutely.
Thank you, Barbara.
Thank you very much for that. Bye-bye, everybody. Bye.